I'd like to call to order the meeting of the pension board for May 11th and seek approval of the minutes from the April 13th meeting.
Do we have a quorum, Frank?
Yes,
Do we need a quorum? We're okay?
we have a quorum because right now there's only 5 on the board and we have a majority.
Okay. I'll make a motion to approve the minutes.
Is there a second, Rich?
You're on mute,
I'll
Rich.
second.
Yeah, weren't you happy? Yeah, I will second it.
Okay, all in favor?
Aye.
Opposed? No. Passes unanimous.
Incidentally, a parliamentarian on another board said that you don't need to vote to approve the minutes if there are no changes.
Well, that's a good
Okay.
note. Okay,
But I don't know whether he got that off of Google, Twitter, or some other
you know,
some
well,
other
I was thinking there should have
website.
been, on page 4, there should be a period after the FYE 23, but so I didn't want to mention it. So anyway, so the minutes are gone. Any public comment? If there's
No, there are no hands raised.
okay, excellent. Is Jerry approval of the pension application? I believe there's one application.
There is.
Jerry?
Can everyone hear me?
Yes, we can.
Okay, we have one application to submit tonight on behalf of Lori Tallcouch, who is the assessment data tech with the tax assessor's office. She is taking an early retirement. She elected option 2, and her monthly benefit is $2,719.51, annualized to $32,634.12.
Excellent. I looked this over. Has anybody got any questions on this pension? If not, is there a motion to accept it?
Motion to accept.
Second,
I'll second that.
all in favor? Aye,
Aye.
Aye.
passed. Thank you very much.
You're welcome.
Next. Thank you, Jerry. Next is fixed income presentation.
Thanks, Frank. So we have Keegan Gorman from Prudential on the line to do a portfolio review of the PGIM Core Bond Fund, which has been in the portfolio since late 2011. Keegan, if you could spend about a half hour, including questions, just a highlight of the process and any changes to the team or firm, and dive into performance and outlook, that would be great.
Yeah, absolutely. Thanks for that, Britt, and good evening, everyone. Thank you very much for the time. I shared a presentation. I just wanted to make sure that everyone has it available. I'll reference some of the pages as we move throughout. And as Britt mentioned, we've obviously managed this investment for a little over 10 years now. So we want to thank the City of Norwalk for being a longstanding client and for affording us the opportunity to serve on your behalf. On slide 4 of our presentation deck, just to help orient where PGIM Fixed Income sits, we are the public fixed income asset manager within PGIM Inc. PGIM is the global investment management holding company, if you will, for the broader Prudential financial organization that you're likely familiar with. So we do focus strictly on public fixed income. There are other affiliated asset managers within PGIM that focus on other asset classes, whether it be real estate, public equity, private equity, and private debt. But we, operate fairly autonomously and have some information barriers to ensure that there's no inappropriate sharing of information. So that 957 billion you can see on your page, that's all public fixed income assets. That's actually as of 12/31. And if we move ahead one slide, I'll spend a few minutes on where we were to end 3/31. So unsurprisingly, with rates up over the quarter, there was some depreciation of the asset base, down about 7%. We did see positive third-party flows that were over the period, focused primarily in some of our longer credit strategies. So pension funds with rates moving up tended to see higher funded statuses over the period, and use that as an opportunity to help cover in some of their underweight to the longer corporate bond space that they tend to run. In addition to that, we did see some offsetting flows in the same area with a lot of pension risk transfer activity going on, actually the busiest first quarter on record. And so that was a little bit of an outflow. Maybe just to spend a little time, you can see that there's broad representation here in that 890 billion across all the different sectors, with focuses primarily in corporates, securitized products, as well as EM and high yield franchises. On the top right-hand side, you'll see that breakdown in terms of client type. So 311 in proprietary, you can think of that as general account assets, which we manage for the parent insurance company, as well as our third-party retail platform through 40 Act mutual funds primarily, and then the third-party institutional, which is where the City of Norwalk's assets would fall. So stable asset base growing over time, but certainly a headwind when you have significantly higher rates over the period, which we'll spend some more time on as we move through. Page 6 is our senior leadership team. No significant changes to this page. Very stable team overall. We did announce earlier this year and effective in January a co-CIO structure between Craig Dooling and Greg Peters. Both Craig and Greg have been at the firm for a number of years now, and are sharing responsibilities really in light of the fact that the investment universe, the number of strategies and the investment professionals on the team here have continued to grow over time, and makes more sense to do it as a two-man operation here as we look forward. But otherwise, no significant changes to the senior leadership team that you see here. Page 7, just a further breakdown in terms of where we're dedicating some of the resources. So you'll see 1,000 employees globally. We are based here in Newark, but have offices in London, Singapore, and Japan, as well as the Netherlands. Continued dedication of a lot of resources, not just within the portfolio management bucket in the middle that you'll see there, but as well as fundamental research. We have one of the larger credit research teams among our peers. We think that's really our key bread and butter, and really one of the key pillars in terms of how we manage the strategies, how we generate returns for our clients, and we pair that with a real focus on risk. Risk is a language that's really ubiquitous across the firm. It's a key focus, and it's something that we probably think about and do a little bit differently than some of our competitors. Finally, I'll just note, you can see, in addition to the long average investment experience on the top right-hand side of that page, what is, also is a little unique is, the average tenure here for folks tends to be pretty high. So stable teams that have managed through multiple cycles together leads to a really consistent process. And something that we take pride in, as well as how it speaks to the culture of working here. Page 8, real quickly, is our composite grid. So this is all of the actively managed strategies which we market. You'll see the core conservative strategy, which we manage for you all, is right at the top. And it lists the respective benchmarks as well as the performance versus those benchmarks over the different periods of time, moving across the page to your right. So those areas where they are shaded green represent outperformance versus benchmark. So we like to see a lot of green on this page. As you can tell, the first quarter has been difficult on risk markets and a lot of underperformance. But what we like to see and what we try to do is really take a long-term approach. And so the 3, 5, 10-year all outperform their respective benchmarks, and that's what really gives us confidence in the consistency of our process and our ability to use active management to help provide returns to our clients. I won't spend any time on page 9. We do have an investor forum. There's details if you'd like to register. It'll be held in person in New York City as well as virtually. So if you're interested, we'd certainly love to have any members of the Norwalk team join, and have a few keynote speakers listed there that we're excited to host. So I'll pause there just on the firm side and see if there's any questions or anything you'd like me to go back through in greater detail before we dive a little bit into the core conservative strategy, which we're managing for you all.
Good go.
Excellent. Okay, so slide 10 is the portfolio management team directly responsible for the core conservative strategy. You'll see it's headed by Stuart Wong. Stu's been with the firm for over 25 years, and prior to becoming the sole head, was the co-head of the strategy along with Jim Herbst. Jim retired a few years ago, and Stu assumed the sole head responsibilities. Stu works along with the sector specialists that you'll see listed in each of the individual boxes below to help do the individual security selection, and they serve as really the experts within those different sectors of the fixed income market to get our best ideas within each of those areas into the portfolios, and ensure that we're positioned consistently across all of the other actively managed strategies. No changes to these individuals listed here. So from an investment personnel perspective, very stable team overall. On slide 11, just to revisit the core conservative strategy at a little bit of a higher level. So we are managed against the Bloomberg Barclays US aggregate. The objective is to try and target about 25 basis points of outperformance over a full market cycle. And you can see where we hope to get those returns broken up by security and subsector selection. Going back to that credit research team that I mentioned, that's really what we believe is our differentiator, being able to look for relative value bond by bond and get that those mispriced bonds into the portfolio. A little bit of sector allocation, so overweighting certain areas of the benchmark more than others, and really de-emphasizing some of the duration and yield curve positioning, things that we think over time are really tough to get right on a consistent basis and represent just a lower information ratio trade. And so that'll flow through to the performance that we'll talk about here in just a second. On that note, slide 13 does have our performance for the Prudential Core Conservative Bond Fund. So this is the fund which the pension plan is directly invested. We do also manage money for the retiree medical plan, which is in a same strategy managed by the same team, all the same objectives, but just a different vehicle based on the asset types. And that presentation and that material is also in here. But given the focus, I'll spend most of my time here. As you can see, first quarter, a lot of volatility in rates, obviously backing up significantly, leading to some negative total returns of about 6%, and negative excess returns of about 13 basis points over the period. For the 1 year trailing period, you can see that the first quarter underperformance is pulling that number down to a negative 6 basis points. But we are encouraged that, like I said, we try and take a long-term approach, and over the 3, 5, 10 positive outperformance, and certainly the since inception number, even beating the alpha target that we look for this strategy. The following page just lists the City of Norwalk specific performance. So that was for the fund level. Obviously, it goes back to 2002. You all have been invested with us since 2011, and so you can see the specific numbers for the City of Norwalk here on page 14. Again, slightly negative for the first quarter, as you'd expect in line with the fund, but positive over the longer term since going back to 2011. I'll spend just a few minutes here on slide 15 and 16, which help provide kind of a backdrop of what went on in the market and help inform that attribution that we'll walk through in a little bit more detail. So slide 15 is breaking down what's gone on in interest rates over the quarter. So huge move higher in yields over the period, with a bear flattener in the front end really selling off. Coming into the year, there was still some hope and thought that maybe the inflation might be a little bit more transitory. We've seen just really persistent prints and the Fed dialing up its rhetoric that it's going to do everything it can to fight inflation. Certainly the conflict in Ukraine with Russia has put a squeeze on energy prices again. And so I think the market realized that the Fed was somewhat behind the curve here in its hiking path and was going to have to get even more aggressive. So going back even to November, December, the idea was, will they do a 25 basis point hike or not? Now it's, they're pricing in 50 basis point hikes throughout the rest of the year, and there's talk about 75 or even 100. So we've come a long way from where we started the year for sure. You can see, flattening of the curve and even an inversion at March month end from that 2-year point to the 10-year point. And so just really representing the market's expectations of continued hiking cycle. Flipping forward here to slide 16, this just looks at, on a duration neutral basis, how did spread sectors do relative to treasuries? And you can see here all the way to the right, the year to date is nothing but negative returns. So really difficult environment for risk product. You can see the US corporate index about a third of the way down, negative 145 basis points, as spreads backed up around that fear of Fed hiking cycle, conflict in Ukraine, and really just a recognition maybe that there was some over tightness in the corporate market coming into the year, as growth from 2021 was going to kind of start to roll over a little bit here heading into the second half of 2022.
Could I ask you a question as far as duration? Have you, because of the Fed's, discussion about tightening, have you shortened the duration in the portfolio?
Yeah, so we came into the year slightly long, about a 0.05 years long duration. And that was really focused in specifically the 20-year point of the curve. But what we did is, in recognition of some of the higher economic prints, if you remember, there was a jobs report that was revised much higher, and then we saw inflation pick up again. We moved to flat versus the benchmark on a duration basis. And as I mentioned earlier, that's typically not where we try and take large risks within this strategy. We want to stay close to home. And so I think in recognition that there was going to be continued hiking, it made sense to go neutral to the benchmark. We did have a slight curve position in. So while overall duration was neutral, we actually were a little bit underweight the front end of the curve, anticipating that as they began their hiking, that's really the point of the curve that the Fed can control the most. And as you saw on slide 15, the movement there was really dramatic in the front end of the curve as the curve overall flattened. So as we get to attribution, you'll see it was a slight positive actually by being a little bit more underweight that part of the curve.
Keegan, what are the guidelines around duration relative to the benchmark for this portfolio?
Yeah, so the guidelines do permit up to a quarter of a year in duration, but we actually tend to set our risk budget. So the internal risk team that oversees this strategy, even within that quarter of a year. So I would say on average, you wouldn't see us, even when we're really highly convicted in the direction of rates, to be more than 0.1 year plus or minus the benchmark. It's really just a low information ratio trade from our perspective, and something that we try and de-emphasize in an enhanced index product like core conservative.
Right. So you, for the most part, you're relatively neutral in terms of duration and seek to get alpha in other parts of the portfolio, which makes perfect sense.
Yeah, absolutely. Yep.
Another question I have is, like, because it's called the conservative fund, what makes it more conservative than, say, are you restricted to say no worse than BBB or A, or can you tell me why it's called a conservative bond fund and not just a regular bond fund?
Yeah,
Please.
yeah, absolutely. So when we think about core conservative, and maybe I'll compare it to just a core vanilla strategy as well, if that would be helpful. So this strategy focuses strictly on sectors of the benchmark, right? So we're not adding things like high yield bonds or anything that's rated below investment grade. We tend to take a smaller amount of risk relative to the benchmark in this strategy compared to a core or a core plus even, which has higher risk tolerance. So this strategy uses about 25 basis points of tracking error. A core, that would be 100, and a core plus would be 250. So relative to some of the other, aggressive strategies or just higher risk strategies, it is on the conservative end. We also don't use any derivatives in this strategy. And so a lot of times it tends to be a little more palatable for lower risk investors that aren't looking to maximize return and really just looking for something that's going to more consistently track the overall fixed income markets. Maybe just one quick note here on 16 as well, just to help frame the attribution story moving forward. You'll see other, main sectors within the benchmark as we move down the page here. About a third of the way from the bottom, you'll see AAA CMBS, negative 71 basis points. So negative excess returns, but maybe held in a little bit better than some of those corporates. And that makes sense, as those AAA securities tend to be a little bit more insulated to spread widening environments. And similarly, you'll see the same for US MBS. excuse me, which was the 71, CMBS had negative 50 basis points of excess return. So just wanted to call those two out as those are large portions of the benchmark, and we'll go through the attribution in a little bit more detail on slide 17. So slide 17, this is how we decompose that 13 basis points of excess return or underperformance versus the benchmark in the first quarter. And we break it up into a few specific categories. Duration and curve, which we've spent a little time talking about. Sector allocation, so were you, did you have more or less risk than the benchmark in any particular sector of the benchmark? And then security selection, which is really how did the individual bonds that you owned in the portfolio perform relative to the bonds in the index? And as mentioned, we were very close to home in duration, so you can see no impact from just the overall parallel shift of the yield curve over the period, but we were a little bit underweight that front end part, which sold off more than the rest of the curve, and so we actually added 4 basis points from curve positioning. We have since reduced that position, so we're neutral now from a curve perspective, just in recognition that a lot of the move in rates that's going to happen during this hiking cycle has really already taken place. From a sector allocation perspective, we did have negative 5 basis points, and you can see that the first base point in that subcategory is from mortgages or MBS. So we were underweight mortgages over the period, and as the Fed came out with more hawkish rhetoric, they were talking as well about unwinding their balance sheet. And back in 2020, when they started their quantitative easing program, in addition to Treasuries, they were also buying agency mortgage-backed securities. And so our thesis was that as they begin to unwind that program and sell, net sell mortgages back into the market, those spreads would be kind of leaking wider as market participants have to take down more supply. And that spread widening and negative excess returns in mortgages, when we had less risk on than the benchmark, added 1 basis point. CMBS, which I mentioned earlier, had negative excess returns, has a -3 here. We continue to like CMBS. We are, really strictly in the AAA rated top of the capital structure. We think that they have a great deal of credit enhancement. So the pool of underlying loans and underlying tranches are going to be absorbing any losses that might come through prior to where we're positioned in the structure. And so we continue to like that, but we were overweight. It's one of the larger overweights in the portfolio, and it did have negative excess returns just as spreads widened pretty much across the market over the quarter. Within municipals, the -3, so these are taxable municipals, so think higher education, the high quality universities, as well as some of the hospital plans or revenue bonds of certain states. Those suffered a little bit from some negative technicals over the quarter. So there was actually a lot of issuance within municipals, and they tend to have a little less liquidity than the rest of the fixed income market. And so when you see a lot of supply of issuance, it tends to reprice the market out a little bit wider because there's no offsetting buys. These bonds don't trade very often, and they tend to just sit in insurance company accounts because they really like the long dated issuance that helps match their insurance liabilities. And we were slightly overweight. And so there was actually one specific deal that helped push that market wider. The University of Michigan came and issued a 100-year bond, and they issued on one of the widest days of the market. And so they came at really cheap levels. We actually bought that deal pretty widely across the platform, but because it came at such a cheap level, the rest of the bonds kind of got marked to where that new market was being made. And you'll see, ironically enough, on the next page, one of our underperformers is their rival, the Ohio State University there. So we'll get more into that page in a moment, but just a little anecdote in terms of the municipal market. Finally, 1 basis point in investment grade corporates, so slightly overweight, and corporates did suffer from some spread widening over the quarter, and that detracted. We'll spend more time on the next page going through some of the key names in there. Within security selection, that Treasury -2 tends to tie in with the curve and duration positioning. So just kind of the bonds that we own tended to underperform a little bit, but it does net with the way we're expressing our curve positioning. Mortgages was a -4. That tended to be the higher coupon season pools where we were positioned, underperformed a little bit more just because they were not the production coupons that were being purchased most frequently throughout the quarter. And James, I'm not sure if that was a hand up for a question. I want to pause. I'm going quickly. Okay, perfect. I'll continue rolling. And so those lagged a little bit over the quarter. And then investment grade corporates, as I mentioned, we'll spend some more time there and in EM on what helped and hurt on the following page. So as we turn to slide 18, on the left-hand side, you'll see the top contributors by industry, top 10, as well as the bottom performing contributors by industry on the bottom half, as well as on the right side, you'll see individual names. So unsurprisingly, oil was reaching new highs. Energy was a really positive performer over the period. And you'll see names like ConocoPhillips, Diamond Energy, and CNOOC, which is the Chinese offshore oil industry, as well as Sempra. Underperformers, that healthcare and pharma is really dominated by the top name that you'll see on the right-hand side, Viatris, -2 basis points. Viatris is the newly combined entity between Mylan and Upjohn, and they had communicated their management some expectations to delever following that merger, and actually throughout the period came out and messaged some share buybacks, equity-friendly activity that spooked debt holders a little bit in fears that they might not be hitting those deleveraging targets, and spreads tended to leak a little bit wider. And we were overweight there, and that was one where we got that one wrong from a credit perspective. But they've since come out and said that they're still committed to investment grade, and the bonds have done a little bit better since then. The following slides walk through the 1-year trailing period. I think just for the sake of time, I was going to skip ahead and maybe talk about positioning and a little bit of our outlook, just given that the first quarter really dominated the performance story. Sure, so slide 21, you'll see our positioning here relative to the benchmark. As you'd expect, very high quality portfolio there on the bottom right-hand side, really not taking large deviations from the benchmark overall. We were flat duration at the end of the first quarter at 6.71, exactly equal with the benchmark, but earning a little bit more yield, which you would expect with a strategy that has a little bit more risk and some more spread product in it than the benchmark. Cmbs there is one of our larger overweights. We continue to like that. I think that it's a good diversifier to some of the corporate credit exposure that we have elsewhere in the portfolio. And finally, you can see no high yield, no below investment grade. So certainly an up in quality strategy overall. I'll pause there and see if there's anything on the portfolio. Otherwise, I can spend a few minutes, I think, that I have left here, just kind of talking forward looking and outlook for the economy moving forward. Sounds good. Okay, so perfect.
I do have one question. What percentage of the AAA is government securities?
Yeah, so you'll see that the 39.2% there on the left-hand side under U.S. government is
Right.
Is all treasuries. The mortgage is also agency mortgage-backed debt, which you could kind of lump in with the governments, and then the agency 1%.
Okay.
You can think about that actually debentures that the individual agencies are issuing. So if Fannie issues debt to build a new office building or something, that's their actual debt themselves, not the mortgage pools that they're guaranteeing.
And those three things individually add up to that 72%.
In addition, there may be some CMBS, which is AAA rated, falling into that category. The CLOs that are in here are all AAA rated, so that would be bucketed there as well. But from a government guaranteed perspective, I would look at the U.S. government, agency, and mortgage lines.
So roughly, what is 70% of the AAA, 90% is government, or is it 80%? I mean, I'm trying to get a feel for.
Sure. Yeah. So if I take the roughly 40% in government and in 25, I'd get to about 65% of that of that AAA bucket is guaranteed by the government.
So roughly 90%.
Yep.
Okay. Thanks.
Sure. Okay. So I'll spend a few minutes, and there's a number of market slides in here. I wasn't going to flip through those just in the interest of time. I was just going to spend a few minutes here just kind of talking a little bit more about the growth picture for the remainder of 2022. So certainly we have growth moderating you know, in our base case for the rest of the year. The Fed is going to be really aggressive in hiking rates, and really has to be, you know, right? They've built up a lot of credibility over the last 20, 30 years in being able to control inflation. And I don't think, you know, Jerome Powell and the rest of the FOMC members want to be the Fed that lets inflation get out of control. So he was asked pretty pointedly in his press conference last week, you know, whether they would be willing to hike the economy into a recession to fight inflation. And he, you know, fairly directly answered yes, you know, if that's needed. Fortunately, we did get a slight ease in inflation that through the CPI print that was released today. A little concerning that the core piece of that was still actually a little bit higher than expected. So you could see the markets didn't digest that too well today. But inflation is going to be the driving story because it's going to kind of drive the Fed in their policy throughout the remainder of the year. So on that backdrop, you know, our base case is for about 3.4% GDP for the US. That's down from about 5.7 last year. So moderating, but still a pretty strong and robust economy and growth picture for, you know, relative to where we were pre-COVID and even, you know, longer term run rates before that. As I think about, you know, within investment grade corporates specifically, corporates are in pretty good fundamental shape here. Leverage ratios have declined from pre-COVID. Interest coverage and debt service capabilities continue to be robust. And we haven't seen some of that shareholder-friendly activity that we tend to see kind of mid to late cycle. So share buybacks or debt-funded dividends, things like that. So while it's a negative overall maybe growth picture here in the near term, we're starting from a pretty good place as far as corporate fundamentals are concerned. And as a result, oh, go ahead.
Yeah, sorry, do you see a recession in the next 18 to 24 months?
Yeah, so it's not our base case that we'll be in a recession probably a year out, but it certainly gets uncertain with the path of the Fed and their aggressiveness hiking. So we have about 200 to 250 basis points of hikes priced in the next 12 months. And interestingly, if you look at the forward curves, one of the first times we've seen this, that they're actually already pricing in cuts after that period a few years down the road. So sort of recognition that the Fed may have to get out in front of inflation and fight it to the extent that it slows the economy into a recession. I mean, we already had a negative GDP print in the first quarter, so certainly a technical recession wouldn't shock us here. And it's one of the reasons that we're not super bulled up on risk overall, right? We're trying to be thoughtful about the level of credit risk that we put in this portfolio, just given the two-side risks that are out there. You know, one of the most sensitive sectors that we've seen, and I'm sure you all have anecdotally heard about, is the housing market. 27% house price appreciation over the last year or so. And that has led to, you know, affordability for new homes really just falling off a cliff, right? So 30-year mortgages have hit new highs over 5%, as you know, coupled with really, you know, expensive home prices and low inventory, right? You can't go out and find a house that's for sale without 10, 15 offers on it. So it's gonna be a sector we're really watching closely to see how it responds to the Fed's hiking cycle. Most of those mortgage rate increases have been priced in already and kind of are represented, but we think, you know, maybe there's some potential for that slowdown, especially as you get to year-over-year comps in terms of home price appreciation. Maybe one last slide that I'll speak to is just on mortgages. I mentioned that the Fed is going to be rolling off their mortgages from their balance sheet during their quantitative tightening. We're positioned to underweight, and we have been throughout this quarter. It was a benefit to us. But we've started to cover that in a little bit as spreads have gotten a lot wider within the agency mortgage-backed space, and we've tended to favor and own the coupons of the mortgage pools that the Fed hasn't been buying. And so our hope is that as they start to sell the 2 and 2.5% production coupons that were from last year during their QT cycle, those spreads will widen a little bit more than the up in coupon season pools that we own in our portfolio.
Do you consider that because refi will be reduced substantially, that you now look at the assumption of duration on your mortgages? Have you changed it to say they're no longer 7.5 years, say out to maybe 9 or 10?
Yeah, so our mortgage team has a prepayment model that they use, and that looks at expected prepayment speed, so refinances or just sales and moves, and it is adjusted based on the level of rates. And so certainly the refi activity here is kind of coming to a halt, and some of these mortgage and loan processors are having to already start to lay off people that they had hired during COVID when refinances were taking off. So we have seen a big extension in the duration of the mortgages within the index, but largely that extension has been fully priced in at this point, right? If you unless you have a legacy 7% mortgage from 20 years ago, if you haven't refinanced at this point, you're probably not going to. So there's some burnout in those pools, and the extension for the most part has taken place to this point.
Thanks.
But a good question, and a question that we get a lot in this strategy in particular, in those accounts where there are duration sensitivities, specifically like stable value plans, where there may be a cap on the level of duration. Mortgages have extended a great deal here. So that's all I had in terms of prepared remarks, but happy to answer any other questions on outlook or other details within the strategy and the economy overall.
I'm just curious, as the firm, what do you see inflation? I mean, I'm a believer that the Fed was wrong for a long time. And to me, they just went from transitory to now people are going to talk about peak. And the Baltimore Orioles might have had their peak number of losses last year, but it doesn't mean they're going to be a winning team anytime soon. And where do you see inflation? I mean, I guess my history is I started in bonds back in the late 70s, and real rates were quite high. When the Fed went to 20%, they were plus 600 basis points. Now they're minus 700 basis points. Do you see that as a problem, that the bond market could really be hit, to adjust to an inflation rate of perhaps 5% over the next couple of years?
Yeah, certainly. So the other thing that complicates too the path of inflation and the Fed's ability to fight inflation, right, is they can really only tamp down the demand side of things by hiking interest rates. And so much of this has been caused by supply constraints, and that's only now being exacerbated by the conflict in Ukraine and all the knock-on effects for the different industries and exports, whether it's fertilizers or food that are impacted by that conflict. So our base case is that over the course of 2022 and into 2023, you might see inflation moderate, settling in for 2023 maybe at like a 4% handle, so it's just a significant move from where we are today on a year-over-year basis, though, because you have to remember that these base effects, after you've grown 8% for 2 years in a row, it's going to be tough to maintain that. And at some point, with the Fed hiking and consumer demand coming down, suppliers are not going to be able to pass through inflation as effectively as they were. And so when we look, we try and assess, how much of the inflation story has been driven by the demand side of the equation versus the supply side. And so far, we've seen that the demand side has started to come down slightly. It's still hanging out at elevated levels, a standard to 2 standard deviations above where we were pre-COVID. And so we're going to be watching that closely to see if that starts to come back to kind of the average. The good news is on the supply side, despite all of these impacts from whether it's ports not being able to get goods in through LA or just other emerging markets that suffer really high inflation as a result of food costs, supply has started to come back more rapidly than the demand side of the equation. So the economist team is looking and updating these projections every single day, It's really difficult to predict. But our base case is that you're going to see that come down over the next 12 to 18 months, but still settle in at a slightly higher level of inflation than we saw pre-COVID.
Have you considered the potential impact on, I guess, mostly supply, but also demand if there's another nasty round of COVID in the fall?
Yeah, certainly. So I think the one thing in 2021 obviously was you had a huge fiscal stimulus as well that was pushing that demand. And I don't know that, given how hot inflation is right now, there's going to be a political appetite to do anything like that if there was a big shutdown again. And so you would probably see the shift in the last 3 months from goods to services that we've seen, right? Airfare, is the prices are much higher. I mean, you're starting to see people book things like cruises again. Maybe those get hit and services continues to contract again, and the demand shifts back to goods. But I don't know that there's going to be the same fiscal tailwind that you would have in 2020 and 2021 when the government was just doing everything it could to get the economy back on track.
Okay.
What about the idea that, when they're running off the balance sheet, so they're going to be shifting from a net buyer to a net seller? Do you think that's going to affect the yield curve? Or
yeah, it's going to be from the Treasury perspective in terms of the roll off, it'll be a little bit more supply for the markets to take down as they net sell. You're going to see a contraction in some of the liquidity, right? That increased cash has had on the market. But from an overall yield curve perspective, I think that the main factor that's going to be really shifting things is more on the inflation side. I mean, the Fed's balance sheet has almost doubled from where we were pre-COVID. And if you recall, in 2018, when they were reducing that balance sheet, there was some spikes in things like overnight repo rates, as just there was not enough liquidity in the system. The starting point here in terms of the roll off is twice where we were then. And so I think that it is somewhat of an experiment, right? They haven't really successfully navigated this QT to date, but doesn't feel like the pace that they've been telegraphing to the market is going to disrupt things too significantly. And they're going to go about it pretty methodically in terms of pacing it out and clearly communicating that ahead of time to hopefully mitigate those impacts as much as possible.
are there any other questions? If not, I want to thank you very much for your presentation. It was quite good. And then we will move on to performance.
Thank you, Keegan.
Yep.
Thank you very
all
much.
very much.
Thank you very much.
Once
Thank
again,
you.
appreciate the relationship, and thanks to Britt and your team for all the work and coordinating.
Thank you.
Thanks, Keegan. All right. Everybody have the executive summary that I sent out? If not, I'm happy to share my screen.
There we go. I'm good.
Okay, good.
Great. Well, to piggyback off Keegan's bleak comments on what the world is and what we've seen in the first quarter, let's just start on page 4 of the PDF. And as you all know, Russia invaded Ukraine, creating significant volatility, along with rising inflation, rising rates, really caused a perfect storm in terms of negative equity returns as well as negative fixed income returns. To put it in perspective, it was the worst quarterly return of the Bloomberg aggregate since 1980. We saw the yield curve flatten, as Keegan mentioned, and a slight inversion, which can be a predecessor to recessions. So something to keep an eye on moving forward. See the S&P 500 down about 4.6% in the first quarter, outperforming small cap stocks by a couple percent. We did see a pretty significant rotation into value. Growth stocks tend to do much worse in a rising rate environment, and that certainly did occur in the first quarter and is exacerbated year to date. So while we discussed on Keegan's presentation, a recession, I think a bear market is down 20%, and year to date, the S&P 500 is down about 15.7% through yesterday, down about 8.7% in April alone. So not exactly a rosy picture, to say the least. It's something to continue to keep an eye on as we move forward. Move ahead to review the portfolio on slide 19, showing the asset allocation versus target. Pretty consistent with past quarters. Overweights to real assets via PIMCO, slight overweight to private equity, and absolute return manager UBS. Overall underweights to total equity, mainly in international and domestic, and slight underweight to domestic fixed income. You can see the cash levels there, just about 2%. We will be bringing a proposal to raise cash at the next meeting for Cmbs, as we do it now at the end of each quarter. But importantly, all the asset classes are well in line with their target ranges. Turning ahead to slide 20, you can see total assets, about 514 million, about 8.5 million going out for benefit payments. And you can see unrealized investment losses of about 27 million during the quarter. On slide 21 of the PDF, just showing the ranges, not particularly close to any of the lower upper bounds. I think international equity is probably the most underweight, but no concerns and no reason to rebalance at this point, unless the board has the desire to potentially reallocate some funds. We have some clients considering rebalancing into public equities, but I think for the most part, people are taking a wait and see approach.
Well, the numbers are going to look a lot different. They already look a lot different, right? So
exactly.
Yeah.
I don't think we should be trying to call a bottom here.
No, we agree.
I'd rather be late by a quarter or two than early by a quarter or two.
Agreed. And this portfolio is meant for a very long-term outlook, and as much volatility as we've seen over the last 4 or 5 months, we think your strategic asset allocation is there for a reason, and sticking to it in times like these is always helpful.
Is that a misprint on Silchester?
Which one? On
Well,
performance?
it's the only black number.
Oh, yeah. So we'll turn ahead to 22 of the PDF to highlight performance.
I'm sorry, Frank, I had to.
Where do we go down to the bonds?
Yeah. Importantly, I did want to highlight LSV. I know they struggled for a few years in that growth market environment, and they had another good quarter relative to the Russell 2000 value. And you can see their 1-year number is exceptional. So very good to see them bouncing back as value has really come into favor. Columbus Circle, on a relative basis, continues to do well. On an absolute basis, obviously, growth indices and growth stocks have been hurt pretty significantly. I did want to confirm with Columbus Circle, no changes in terms of their client base. If you recall, it's quite concentrated at the moment. We'll continue to report back to the board on any updates there, but it seems that things have stabilized there, which is good. So we have confidence that they can continue to gather assets going forward. International equity, Rich highlighted Silchester. They did well to eke out a positive return. You can see just how much better the EFA value index versus the EFA growth index did, to show that growth and value discrepancy, almost 12% just for the quarter. Artisan had another poor quarter. Their returns have been really disappointing. Be attributed to some of their Russian exposure, some of the European financial exposures. We are open to considering other candidates if the board is interested. We don't have any changes in terms of the team. And Mark Yockey, who runs the strategy and has for a very long time. But the reality is their performance continues to disappoint. And it's really over all time periods. So I did want to bring that up and see if the board had any reaction to Artisan.
One of the things is that could be our cash cow. You know, when we're going to need to raise cash next meeting, right? I mean,
It
we
could,
did-
but you're already pretty underweight international equities. So I certainly
Those-
from a trim perspective, we would agree, but in terms of any significant cash raise, we think it should probably broadly be pulled from throughout the portfolio to make sure that
Yeah,
not
I
taking
wasn't
money and-
I wasn't a real fan of, I thought Artisan was strained from the mandate.
well, the tough part about this particular strategy is they're really a benchmark agnostic strategy. Technically, they're benchmarked to the EFA index, but if you look at any holdings-based metric, they are a growth manager. And the bucket that they are playing in this portfolio is as international growth manager. And-
International ex-US?
Well, it's EFA, which includes North America. So there is some underlying allocations within the EFA index.
Do you think a place to look is growth ex-US? Is that a place where we're perhaps underrepresented? Because I would feel that we would do that. There are enough funds that are focused on US growth opportunities. And I would like to, I think there'd be more expertise there for the US, and then, you know, an international growth expertise requires a whole different infrastructure, I would think.
Yeah, I think that's fair. We have a lot of clients who their international markets would be ACWI ex-US. You can see that includes emerging markets. So it would more be at the manager's discretion on how they allocate to emerging markets. It makes up about 30% of the index. What we could do is take a look at the international and emerging markets equity structure to see if something like that is feasible.
Mhm.
You know, I think historically the dedicated emerging markets manager has struggled within Norwalk's portfolio. I know the BlackRock replaced Aberdeen and another manager that I can't remember off the top of my head, but they've struggled. And you know, there is substance to giving the portfolio manager the ability to allocate within EM, within the fund as they see fit, and not try to control the allocations there from fund to fund.
Are you saying that there's really not a developed non-US growth company manager?
No, I'm not. I'm certainly not. And,
I mean,
and that was,
but that's sort of what you know, I think EM is different enough as a I don't know what I want to call it, a sector or an exposure that I'm not sure I want to take it in a international growth fund.
fair.
You know, I would personally, I'd rather see us, you know, as I said, do a developed market, non-US growth manager, and that's the lane that, and see them stay in their lane.
Sure.
Because we have, you know, we have enough allocated to to US growth. I think if we wanted to do, emerging markets, well, we have some, we have our emerging market bucket. And I'd rather keep that, where it is, where we can make a decision about emerging markets without having to keep in our mind, oh, we have some of this growth manager and he can run in that lane too.
Right, and that's how this portfolio is set up. And we can certainly bring back a short list of developed international growth managers that we have conviction in to at least review and see what's out there, and we can bring that back at a future meeting and see how the board feels about the candidates, and we can bring a few in to interview to get their perspective as well.
What do you feel, James and Jim and Frank?
Well, I was going to ask Britt, how do you sort out the differences between, a company that's based in the US and does a majority of their business internationally versus a company based internationally? Yeah. I mean, what's international, I guess, is the question. When is it?
Yeah, I mean,
revenue
you could
sources,
argue,
profit sources, headquarters, what defines international?
so I think technically it's where their headquarters are. So according to the index provider, it's where the headquarters of that company are. I think you could argue, the exact opposite with the S&P 500, right? Every one of those companies has significant businesses internationally. So it's really not necessarily as clean of an exposure as you might expect. That being said, I think, one thing that we've heard from Silchester and we see in Silchester is they know their guidelines and they stick to their guidelines, and they have a very well-defined role in the portfolio. I think Artisan is a manager that will tend to be more of a go anywhere type manager. If they see somewhere company in North America that they feel, is misclassified in the index, and they think that they have a growing business, they will buy them. So it is a different philosophy in terms of how they think about those kinds of companies.
Yeah.
I think that personally, I was not impressed with Artisan's presentation, and I was happy to hear Charlie propose that when we wanted to raise cash, that we take it out of Artisan. And really, growth has been the story for the last number of years. And if you look at it, the MSCI index for growth is outperformed by 100% the value. And yet Silchester has outperformed Artisan. So, I would be happy to look for someone else, but I'm also probably be satisfied if we took money out of them. They're one of the poorest performers since we took money away from them. They've consistently not done well. To maintain diversity is fine, but also to be diversified. And I agree with Rich that we're not trying to pick bottoms and shift around too much, but the difference of $5 million is 1% or so. And again, I think that they were scattered and their performance is poor.
I think that's fair. So it'll take me a little bit to work with our research team to come up with a short list of semifinalist candidates to bring back to the board. I know summer is here, but we'll do that as quickly as we can. I don't think we'll be ready for the next meeting, but shortly after we'll be able to distribute it and can set up a discussion.
That sounds good.
Perfect.
Great. All right, moving forward, BlackRock, you can see their performance has been underwhelming as well. Most of their relative underperformance has been from energy names, as well as some allocations to China, as we've seen both the COVID crackdown as well as corporate crackdown within China. So we keep an eye on BlackRock moving forward. Still has not been in the portfolio very long. Within the long short managers, the ABS has done okay. I think most of their relative underperformance has been driven by a underweight to tech, and particularly large tech. And I would hope that that would continue to be a benefit to them year to date going forward. On the other hand, Blackstone has performed quite poorly, to say the least, over the quarter and 1 year. They, on the opposite end of the spectrum, have some fundamental equities managers under the hood that are very concentrated, high growth technology names. And we would suggest bringing Blackstone into the next meeting to present, if that's agreeable. Because longer term, they've done okay, but really poor performance over the last year.
I would expect long short managers to do poorly in the period ahead, because they're getting killed on both their longs and their shorts. I was talking with the manager the other day, is that they lost 7% on their longs on, I forget what day last week it was, and 7% on their shorts. I mean, so there's the amount of degrossing that's going on is huge, and I think it's going to be a real tough road ahead for that sector for the next 6 months at least.
Well, you know, one of the things though, that they were supposed to be a buffer, in the sense that, well, when the market was going up, they were going to underperform, and we accepted that. But now the market's going down and they're underperforming. So, you know, I mean, I also talked to a hedge fund guy yesterday, and, you know, the guy you have to lose 7% and on both sides. I mean, that's like, I don't even think you could do that if you tried, but.
Well, I saw it in 08 and 08 for weeks on end, just with liquidation. And I think that's sort of what we're seeing now. The risk managers are coming in and tapping people on the shoulder. Their books are being liquidated.
I guess to me, if you get the right shorts on when people are liquidating, that's when you're supposed to do really well. Like if you're short, you know, like Peloton and Beyond Meat and all those other things that I think are worthless.
But then you got to go buy them, you know, I don't know, it's not easy.
I mean, do you think that, you know, being down, underperforming by against the S&P 22%, would be better off buying T-bills? You know, I mean, they haven't, over 7 years, they've underperformed the S&P by 1,000 basis points. That's fine in some ways, but it's still, I guess I'm pretty surprised that their performance is as bad as it is.
Well, one of the things you get out of a hedge fund that really doesn't have a lot of value for us is they will have a lower Sharpe and lower risk than the S&P, but that has no value to us.
Well, that idea though of that it was going to be lower risk in the S&P, it isn't showing up now in the last year. Like I said, we accepted underperformance for three years against the S&P because we understood that we just needed, that was kind of, I think Brett described it sometimes, that's kind of like an anchor to the portfolio. But now they're like well underperforming.
Yeah, I'd say that they're certainly less correlated, and certainly the beta to the equity and fixed income markets is going to be definitely diversified versus the rest of the portfolio. I think with ABS, you can see that coming through. while they were down 4.4 for the quarter, I mean, you look at some of these growth markets, emerging markets, US growth, they weren't down the levels they were down. I'm not saying it's justified, but the strategic index above them in the performance report, which is really a broad peer group of long short managers, you know, ABS has done reasonable versus their peers, and Blackstone has done not reasonable at all, which is why we want to bring them in and have them present to the board, because the performance we've seen since really the start of 2020 from Blackstone has been dismal.
So we'll have them come in June? Is that
If that's agreeable.
agreeable?
Yeah, sounds good to me.
Yep. Perfect.
That works.
Great.
We
So
don't have any
private
gates. We don't have any gates, do we? Or is it a quarterly redemption? What's the,
I think Blackstone is quarterly with 90 or 95 days notice. So it would take a good 6 months to get your redemption from the time you put that in. And given the volatility, there is potential for gates, I believe.
how much do we have there?
20 million. 21 million, roughly.
And that might be another source of future redemptions to pay benefits.
But not with a, with the window being so wide. If we're thinking of doing that in 2022, we should put in a redemption notice for if they only accept redemption notice at the end of the quarter to be paid at the end of the following quarter, where we would have to do that in the next few weeks to get money by the end of September.
It's a good
Right.
point.
Yeah, I
Maybe
can confirm
maybe
when-
that's something we want to do. Maybe we want to lighten up by, by, I don't know, $5 million.
Sounds good. What do you think, Jim?
Yeah, I'm okay with that. You can't look at the performance and not say there's something wrong here.
Is there a motion that we
How much have we got here, by the way? We've got
had 20 million? It's going to be
20.
probably less than, it's 20
21,
point,
20,
20.
21 in March, yeah, so.
which could be 20, let's say, I'm guessing 20 roughly. So we could do, I mean, is there a proposal like to take 5 million or 6 million or?
Well, first, Britt, do you know their performance for April?
No, I do not. They're, as a hedge fund does.
Yeah, they're late, yeah. Okay.
Typically reports very late.
Yeah,
Would there be a proposal, Rich, to a motion to take a certain amount of funds? Because like you said, it's. we
Yeah,
have to do that.
I moved to put in a redemption notice to Blackstone Park Avenue Fund for $5 million.
Is there a second?
I'll second that.
Is there any discussion? And if not, all in favor?
Aye.
Opposed? No. Passes unanimous. Thank you.
I will work with Chitsmay to make sure that's submitted, and we'll invite them to present at the next meeting and can make a broader decision if necessary.
Perfect.
Private equity, these returns are lagged. So it remains to be seen how private equity is going to hold up in the first quarter. But as you know, returns over the past 3 to 5 years have been extremely good. You can see about 20% for the last year. Then on page 23, I think, we heard from Prudential, who's really meant to be that conservative, plain Jane fixed income. One of their fee is extremely low, and if they eke out any alpha, it's a positive. And you could call them a quasi-passive manager because you can't really buy the index in fixed income, and net of fees, passive managers tend to only underperform. So they continue to do their job. You can see Met West, they're really the manager that will allocate to the plus sectors like high yield, emerging markets debt opportunistically, which did not work in the first quarter and the trailing year, but over longer periods, you can see their performance has been reasonable. I think one of the real highlights of the portfolio is UBS. So this absolute return strategy seeking to produce a positive return in any market environment. And I think they proved that in the first quarter, which was great to see, and have a very strong trailing 1 year return, about 6.4%. And then finally, you can see PIMCO trailed for the quarter. Their inflationary exposures have done well, but as you know, they do have some equity and fixed income exposures under the hood, which underperformed in the first quarter, but longer term continued to be strong. So overall, the total fund was down about 5% for the quarter. The 3, 5, and 7 year periods continue to be strong on an absolute basis and well above the discount rate. And if we turn ahead to the next 2 pages, 24 and 25, just detailing the fiscal year, much of the same story across the manager performance, but the total fund fiscal year to date with a few months left, or 1 quarter as of this report, was down about 2.1%. I'll pause there. Happy to answer any questions on performance.
Any questions?
Yep.
Nope.
Good.
If not, the only thing is, like, Jitsime, could you, maybe last time you requested cash, maybe you should have asked for 50 million. That would have saved us some. Okay.
Who knew cash in an inflationary world was a good thing?
Right. I mean, even Ed Hyman, the economist, he was interviewed and he said he likes cash, which I was kind of surprised at.
Wow.
Anyways, if there's no other discussion, is there a motion for adjournment? Or Chitsime, do you have anything for us? Has it been, I'm sorry.
I was just going to mention that the city contributes to the pension fund at the beginning of the year. So our fiscal year starts July, and the actuarial determination employer contribution for FY23 is around 15 million.
Do you have the number for the OPEB?
I don't have the OPEB number in front of me because the OPEB actuary report is not completed yet.
So will you need cash between now and when that money hits?
Yes, because right now our cash is around 6 million. So at the end of June, I will have 3 million. So to get me through the summer, I'll probably ask for around 6 million.
Including that 15?
No, the 15 is, no, it wouldn't include the 15. The 15 is separate. So out of the 15, I would probably just take 6. I'll need 6 million to get me through the summer.
Okay.
And Chitsime, we can touch base and we can bring a proposal to invest the contribution once it hits, and as well as a recommendation for cash as necessary at the next meeting.
So
You need us. I'm sorry, Frank, go ahead.
Chitsime, so if we're gonna get 15 million in July, how much do you think that we're gonna need in June?
For the benefit payments?
Yes.
Okay, so we're good through June. So June will have about 3 million
Okay.
in cash available. So to get me through the summer, July, August, and September, I would say I'll need 6 million.
So you could just take that out of the 15 million?
Correct.
Okay, so that would being that we don't need to raise any cash at the next meeting. Is that correct?
If the board agrees.
I mean, no, it's whatever you want. You know, if you want money, we'll give you money. You know, we just don't know whether you need it or not.
No, I mean, I could use the 6 million from that 15 million that the
Yeah.
city will be contributing.
Okay.
But that decision doesn't have to be made now.
Correct.
Plus, I want to take money from Artisan.
Well, that's for September, so maybe that'll get us through October.
Right. Any other discussion? If not, is there a motion for adjournment?
Motion to adjourn?
And is there a second to that?
Second,
And all in favor? Aye.
Aye.
Opposed? No, passes unanimous. Excellent. Thank you very much, everyone.
Thanks, everyone. Have a good
Good
evening.
night.
Yeah,
Yeah,
too.
bye-bye.
Bye now.
Okay.